Good morning. It's Thursday, August 6th. The S&P 500 closes at 7723, down 17 basis points. The Dow prints a fresh record at 54,349. The Nasdaq, down 83 basis points, dragged by SpaceX and AMD. Gold touches a 7-week high at 43.21. Bitcoin holds 64,470. Oil slips to $75.02. And the VIX, 15.81, down 4% on the session. Healthcare leads at plus 127. Materials right behind at plus 123. SolarEdge collapses 30%. Moderion rips 31% higher. This isn't a market. It's a stock picker's market. And the regime just flipped. This is Markets Daily. We have the regime breakdown, 3 institutional-grade trade setups, and the 2 lenses that separate noise from signal. Start here. The 10-year yield at 4.617%. The 2-year at 3.725. The 30-year at 5.174. Yield are falling across the curve. The dollar index ticks up to 99.73. Gold rallies to 43.21. The VIX compresses to 15.81. And the S&P range-bound at 77.23. This is the fingerprint. Falling long-end yields with a rising dollar. Growth concerns dominating inflation fears. The institutional model assigns 95% confidence to a deflationary regime. The historical parallel? March 2020, liquidity crisis dynamics. But this isn't a crash. It's a slow-motion repricing. The regime is well-established and likely to persist near-term. So what's the playbook in a deflationary regime? Equities, underweight. Earnings compression risk is real. Bonds, overweight. Deflation benefits, fixed income. Gold, neutral. The inflation premium is draining. Crypto, underweight. Risk-off dominates. Dollar, overweight. Purchasing power strengthens. Commodities, underweight. Demand destruction is the story. Look at today's sector rotation. Materials at plus 123. Biotech plus 74 basis points. Defense plus 65. AI robotics plus 57. These are defensive and tangible asset plays. Meanwhile, consumer discretionary barely positive at 30 basis points. Financials plus 21. Real estate flat. Money is flowing to quality, to cash flows, to things you can touch. Up 30.81% to 297.08. 52-week range, 104.63 to 304.58. This is a 14-bagger from the lows. P/E at 62.2. But look deeper. Revenue growing 30.8% year over year. 2 of the last 4 quarters beat estimates. Last surprise? Plus 23%. Insiders are aggressive buyers. MSBR at 100. Options market. Put-call ratio 0.59. Call dominance. Institutional positioning is bullish. Analyst consensus, strong buy, 80% bullish. This isn't a meme move. Segment target time, visual cue. Cold open midnight to 0:45 split screen. 4 asset tickers. Regime briefing 0:45:2 regime BAD, neutral, Mickey signals. Index scorecard 230 to 415 heat map plus exact levels. Sector rotation 415 to 545 XLV/XLB/XBI leaders board. Movers deep dive 545 to 1033 gainers/3 losers. Fundamentals plus options. Cross asset matrix 1030 to 1300 hours gold, oil/BTC/DXY/yields correlation grid. 2 lenses 13 to 1500 hours split screen. Contrarian versus liquidity. Trade ideas 15 to 1633 tickets. Aggressive/moderate/conservative. Scenario playbook 1630 to 1730 bull 40%/base 45%/bear 35%. Key levels and close 1730 to 1800 hours S&P 7,724 BTC, 64,470. The S&P 500 closes at 7,723. It just dropped 4% to 1581. Every major asset class moved today, but they didn't move together. That's the story. And this is your daily institutional grade breakdown. No hype, just the numbers, the drivers, and what you do with them. Let's start with the regime. Our models show a neutral, mixed signal environment, but underneath, there's a 95% confidence reading for a deflationary bias. The 10-year yield slipped to 4.617%. The curve is steepening on the long end. The 30-year dropped 31 basis points to 5.174. That's not a growth scare. That's a duration bid. In this regime, the institutional playbook says, underweight equities, overweight bonds, neutral gold, underweight crypto, overweight the dollar, underweight commodities. But, and this is critical, correlation between asset classes has broken down. The VIX falling 4%, while the S&P barely budged. That's not complacency. That's indecision. The next catalyst, CPI in 5 days, becomes the single most important variable. Historical parallel. The liquidity dynamics feel similar to March 2020, not the crash, the policy response phase. Central banks have unlimited tools to fight deflation. The asymmetry favors positioning for the eventual response, not chasing the downside. But until that catalyst hits, stock picking beats index betting. This content is for educational and entertainment purposes only. It does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions.